I mean, those are the flies in the ointment, if you will. I don't think that, AI producing a lack of ROI is a fly in the ointment because AI is producing a lot of ROI. I
Right.
think MIT study just came out, I think it was yesterday morning, that said that people that are using AI agents at work are proving to be 60% more productive. So there's a big bifurcation happening in the markets. Markets are blasting higher because of the ceasefire, but it's really an AI catalyst. It's not like a whole market catalyst. A lot of kind of the stalwarts of yesteryear are really lagging and not catching a bid, but you're seeing the AI stocks really catch a bid. Stage 4 breakdown here in 22. And then we were basically in a stage 1 consolidating pattern throughout 22, 23, and 24. And then here in 25, I'm seeing the beginning of a stage 2 breakout, similar to the beginning of a stage 2 breakout we saw in May, April of 2020. This is a breakout on ARK. I think ARK is about to go parabolic like it did during 2020, 2021. That's interesting because okay, yeah, maybe buy ARK, that's cool. But it's more interesting in what it says about the market.
Hi, and welcome to Being Exponential with Luke Lango, where we'll go over the economy, markets, technology, and lifestyle, all from an exponential perspective. I'm your host, Brooke. It is June 24th. Let's dive right in. All right, Luke, we're going to pick it up today with the topic we talked about last week. You referred to it as noise, but it seems like the noise got a little bit louder. The U.S. did a military strike on Iran. I know it hasn't affected the markets yet, but it does seem a bit worrisome. What are your thoughts?
Right. So, well, first off, excuse my different setup this week. When you live in Phoenix, Arizona, as I do, and you have to go through the summer months, you try to get away from Phoenix, Arizona as much as possible during those stretches where it's 100 days in a row of over 100 degrees. So, doing some traveling, came to visit my folks this week, so down to my folks' place here in San Diego. So that's why we got the unique setup. Just want to explain that. But yes, let's talk about the markets and how they're reacting to the tensions in the Middle East, or maybe how they're not reacting to them. Um, I think what's going on over there is I think we got the final chapter in a short drama. That a lot of people were afraid that when the U.S. struck Iran and those nuclear facilities on Saturday night, that was going to be the opening salvo of a yet another long drawn out conflict in the Middle East. But I don't think that's the case. I think rather it's the final chapter in a short drama. You had a 12-day war basically, and it ended with that big strike. I mean, it technically ended when Iran responded on Monday, but that was a symbolic response. It was exactly what a lot of people thought it would be. They planned an attack on an airbase, but then they told the U.S. they were going to do it before they did it. It was so widely telegraphed. Airspaces got closed. Things were evacuated. Defenses were up and ready, and there was no damage. So it allowed Iran to save face on the global geopolitical stage, but ultimately didn't escalate things. And now we are where we are, where we have essentially the U.S. backing out of it and Israel and Iran agreeing to a ceasefire. So I think when it comes to the tensions in the Middle East, I think they're cooling down, and you're seeing that in the market. I mean, the S&P 500 is blasting higher. I think it's now within 1% of an all-time high. As we're recording this on June 24th, Tuesday, the Nasdaq is set to close at its first record high since February. So stocks are completely ignoring it. And actually, what you're seeing, this is where I come into play. What are the stocks that are actually performing well right now? It's AI stocks. Right? Suddenly, it seems like the ceasefire agreement in the Middle East is actually a massive catalyst for artificial intelligence development. When I look at the market today, I got the S&P 500 up about 1%, but our AI Builders 15 index, which we've talked about before, is up 4% today. And I got a lot of AI stocks in our model portfolios that are up more than 5% today. Meanwhile, I'm looking at like Costco, it's down today. Looking at Home Depot, looking at Walmart, looking at Coca-Cola, looking at Pepsi, they're all barely up 1% today. So there's a big bifurcation happening in the markets. Markets are blasting higher because of the ceasefire, but it's really an AI catalyst. It's not like a whole market catalyst. A lot of kind of the stalwarts of yesteryear are really lagging and not catching a bid, but you're seeing the AI stocks really catch a bid. And I think one of the reasons that is that if you remember before the Middle East conflict, Trump did his big kind of tour in the Middle East, and as a part of that tour, we had a lot of AI deals announced. Right? We talked about
Right.
it on this podcast. I think about big oil turning into big AI. That money was kind of, there were question marks around it because of this conflict. Right, like if Saudi Arabia gets drawn into a conflict in the Middle East, if the UAE gets drawn into a conflict in the Middle East, all of a sudden, all those big deals they announced, they may get delayed, they may be reduced because they got to spend money on fighting, on defending, right? But that's not the case. Instead, this conflict's over, and so all those big oil deals turning into big AI deals, that's on. I think that's fully on, and that's a huge boom for AI, especially at the infrastructure layer. We talked about our AI Builders 15 index, our AI Appliers 15 index. That's only up 2% today. The Builders 15 is up 15%. So you're seeing the infrastructure layer outperform the application layer because I think the big oil money is coming into big AI. That means more money at the top of the funnel to start. So you're going to see the builders boom first. So that's sort of my read on what's going on in the Middle East right now and why it's actually the way it's evolved is actually a positive for the types of stocks we cover here in Being Exponential.
Yeah, fascinating. I have one fears for the worst case scenarios, but it does seem like it is over for all intents and purposes. Now, I do have to bring up a point about oil. We
Mm-hmm.
assume the prices would spike, but they seem to have gone down. How do you think that affects the current atmosphere at the moment?
Yeah, I mean, I think it's super helpful. One of the flies in the ointment of the bull thesis on stocks was reinflation, right? That has been the
Right.
big fly in the ointment. We talked about it during tariffs, like were tariffs going to cause reinflation? But a big reinflation pressure, probably the biggest reinflation pressure, is oil. Right, because again, as much as we like to think we're not an oil-driven economy, we are. The price of oil flows its way into everything, the transportation of goods and services and everything. So if oil prices go up, inflation goes up. And I got a chart for you here to look at that. Um, so here in white, we have the daily oscillations of the oil price over the last, couple years. And then in blue, we have the trajectory of inflation month to month. They track each other perfectly, right? When oil prices drop, like here in late 23, inflation drops. And when oil reheats, inflation reheats a little and it drops. Then inflation drops and it reheats, inflation reheats, right? So they move in tandem, with some lags and some variances, but they move largely in tandem. Well, if you look at the recent, I mean, yeah, this was starting to become a worry. Oil went from 60 up to 75 and went vertical in a couple weeks. Looking at this chart, that's problematic.
Mhm.
Had this spike continued, then all of a sudden this blue line, it's got to go up. So inflation at 2.4 turns into inflation at 2.8, 3.0, 3.2, and all of a sudden we don't get rate cuts, and all of a sudden the economy does stagflate, and all of a sudden markets do go lower. But what's really helpful is that, yeah, we got the ceasefire and boom. I mean, look at that. It's a straight line plunge. And now we're back down to $64, $65 oil, back where we were essentially before any of this started and where we were throughout April and May when inflation was 2.4. So this big spike that you see in the white line is not going to show up in the blue line because it was so temporary and short-lived. Instead, the blue line is now just going to catch up to the white line right around here, 2.4, 2.5. Inflation stays steady. So that's a big positive read through for the markets, in my opinion. It emphasizes the fact that we are probably going to get rate cuts here in the second half of 25, and that's going to provide further liquidity for markets to go higher. So I think the oil picture, or what we're seeing in oil prices right now, is very positive for most stocks. Not positive for oil and gas stocks, not positive for a lot of energy stocks, but positive for everything else in the market, especially just broadly for the economy.
Fascinating. Awesome. Now, I do have another thing I want to mention before that, but I do want to touch on rate cuts. Now,
Mhm.
Donald Trump is very very vocal about cutting rates.
Yep.
And it seems like that is what is coming in July. How can we use that to our advantage, Luke?
Yeah, so I don't know if rate cuts are coming in July. I mean, if we can look right now, I'm sharing another screen with you. We're looking at the world interest probability matrix out from Bloomberg. The odds of a July cut are first full cut doesn't get priced in until September. So the market's looking at a first cut in September. We did have two Fed governors come out here and say, I think it was Michelle Bowman and Christopher Waller coming out here and saying, hey,
Right.
we should cut in July, or at least we're open to a cut in July. Powell didn't give a date for it. He's like, yeah, we're open to cutting sooner rather than later. Didn't say it was July or September. Market's playing it safe, says September. I think it could happen in July. It doesn't really matter. The point is, look at the curve. This is the curve, the projected curve over the next, year or two. Rates are going to go lower, right? We're looking at 2 rate cuts this year. We're looking at essentially 4 to 5 rate cuts in over the next 12 months, and then 5 rate cuts into the end of end 26. So that's a lot of rate cuts. All those rate cuts are really going to help the market, because if you look at the market right now, it's richly valued. P multiples are very high. The spread between earnings yields and bond yields very, very, very tight. You need that spread to widen to support further valuation multiple expansion on the market. And so if bond yields go down, it will allow for P multiples to go up. And that will allow for valuation multiple expansion on the market, and that'll push stocks higher. So I think that's a very big piece of the bull thesis on stocks. But more importantly, here in this podcast, we like to talk about exponential stuff, exponential stocks, tech stocks, AI stocks. How does it relate to that? Again, I like to see the parallel of 1998, 1999. Okay. That was like the 6th or 7th inning of the dot-com boom. Then we had some hiccups in the global economy, fears of the bubble popping, fears of the economy going into recession, fears of a massive slowdown, and then the Fed rode to the rescue, and we got multiple rate cuts in the end of 98. Those multiple rate cuts in the end of 98, I believe it was 3 rate cuts at the end of 98, went from 5.5 on the Fed funds to 4.75, I believe. Those rate cuts are what added fuel to the fire of the dot-com boom, like unreal fuel. 1999, the entire NASDAQ doubled. The entire index doubled. Went up 100%. That's wild. Best year ever for tech stocks, because you got rate cuts juicing the rally in the final innings of that rally. I think we're kind of at the halftime point of the AI boom rally. If we get rate cuts to juice up the second half, that second half is going to be really, really exciting. And that actually brings me to a chart I haven't looked at in a while. It's one of my favorite charts ever. I think maybe my favorite chart right now. And that is a comparison. This is uncanny, bro. Just take a look at it. This is unreal to me. I don't understand how this is so strong. The correlation is so strong. In the yellow line, that kind of like yellow green line, that's the NASDAQ composite, the price trajectory of the NASDAQ composite from 1995 to 1999. Essentially, the performance of tech stocks after Netscape launched in late 94, 1995, 96, 97, 98, 99. Internet stocks during the dot-com boom. The orange line is the NASDAQ composite after the launch of ChatGPT, 2023, 2024, into 2025. So AI stocks during the AI boom. Look at how closely they are aligned. I mean, it's unreal how much these two are just mirroring one another, right down to the recent collapse, right, during the trade war, and then the big V-shaped recovery. It's truly remarkable, in my opinion. And I think we're going to continue to follow this. So if we do follow this price analog, I mean, we got another 1, 2, 2.5 years left of the AI boom. And those 2.5 years could be the best 2.5 years. I mean, you look up to this point, this is benchmarked to 100. So the NASDAQ during the dot-com boom went 100 to right about now is 194. And then, boom, it finished at 550. Benchmark's 100. So, that's unreal. That means we're at 190 right now. We go to 550. That means the best is yet to come. And if you look at when the best actually did happen, 98, 97, 98, those are pretty good years for internet stocks. But it was 99 was the big year. 99 was the wealth was made in 12 months year. right? That was the year where fortunes were made in less than a year. That's when Mark Cuban sold his business and became the billionaire that he did. That's when all of these big deals happened, was 99. And that's because right around here when things got choppy, right in this era, September, October 98, that's when the Fed cut. Fed cut here and then boom, rocket ship. So if we get Fed cuts right around here, maybe this actually happens earlier. I'm not sure, but what I do know is that what comes next is likely to be better than what has already happened in the AI boom, partially because of rate cuts, which are becoming more likely because tensions in the Middle East are cooling and oil prices are collapsing. It's all connected and it all comes back to AI stocks winning.
Gotcha. Yeah. So I did want to dial into a specific section of AI stocks. Now, I want to talk about defense and AI stocks.
Mm-hmm.
I read a couple of interesting articles about how executives in Meta, Palantir, OpenAI, and I think another company have been sworn into the reserves. Do you think that's an indicator for a large boost in defense and AI stocks kind of rising higher?
I think the whole defense AI thing ties in with what we talked about last week of sovereign AI, right?
Right.
Countries building nation state AI that can run their healthcare systems, run their energy grids, and run their defense systems. So I think companies are just going to pour more and more money into sovereign AI, and I think a lot of that money is going to be indexed towards, okay, running our defense systems and improving our military operations. So I think the sovereign AI and defense AI trends go hand in hand. And yeah, there's been a lot of great stocks in that trend that are just getting more and more mojo as geopolitical tensions rise. One of them that we've owned a long time in our breakout trader portfolio, which is one of our portfolios that focuses on stocks that are breaking out, as the name implies, is Kratos. Kratos. We've owned this one for a long time. And look at it. I mean,
Mhm.
it's been a massive winner. Back in December of 22, this was a $10 stock, and now it's a $40 stock. That's a 4xer in, you know, 2.5 years, about, a little bit less than 2.5 years, a 4xer in a defense stock. That's pretty awesome. And a lot of this gain has come in this, in 2025, amidst trade wars, amidst geopolitical chaos, amidst wars in the Middle East.
Mhm.
That stuff does create tailwinds for defense stocks. Katos has been one of the biggest winners there. So I like this one quite a bit technically extended in the short term, as you can see above what I view as the kind of uptrend channel for the stock. But nonetheless, I think there are a lot of opportunities here. Raytheon, Boeing, Lockheed Martin, those are the big boys, Northrop Grumman. But there's a lot down the line, like Kratos, that probably have more alpha potential and are really worth looking at amidst the current environment.
Gotcha. Yeah. So the market is pretty hot right now. I know we've discussed a lot of the things that could potentially kick it back. Potential world wars and anything like that. Do you think there's any other factors that could knock this hot market back outside of what we've already discussed?
That could knock it back. The flies in the ointment, if you will, higher oil prices. It's kind of
Mm,
being taken care of. Tariff-driven reinflation. I'm not concerned about tariffs because I think there's loopholes for all of them, and there's exemptions,
right.
and they're getting delays and pauses and all this stuff. So I don't see that becoming a real big thing. We haven't seen tariff-driven inflation yet, and I think tariffs are only going to get smaller and smaller and smaller. I think that's kind of like all smoke and mirrors, really. So I'm not worried about that. The 10-year Treasury yield, we're moving lower on the 10-year quite substantially, 4.5 to 4.3. I'd like to see that go even lower, and I think rate cuts are coming, and I think we will get that 4.3 down into a three handle, maybe 3.5, maybe 3.3, 3.2 would be great. That would unlock further upside in the markets. If that spikes to 5%, we got a problem. I don't see that happening because if inflation remains calm, I think we're a okay there. Um, I mean, those are the flies in the ointment, if you will. I don't think that AI producing a lack of ROI is a fly in the ointment because AI is producing a lot of ROI. I
Right.
think MIT study just came out, I think it was yesterday morning, that said that people that are using AI agents at work are proving to be 60% more productive. So it's like the ROI is there. Like absolutely the ROI is there. And another way of looking at the ROI is there, kind of like the dark side of it, the underbelly, is all these layoffs. Right. I mean, it seems like
Right.
every day
Exactly.
I'm reading about more layoffs, like Amazon or Microsoft or Meta. Or, like, there's layoffs everywhere. And it's because it's the companies that know how to harness AI and realize, you know what, we have a lot of repetitive work in this organization. We can cut jobs and just have AI do that. If that's not AI proving ROI, it's sad, but it's AI proving ROI. If you have AI that can replace a job, that's ROI, right? Like that is perpetual savings there. So I don't think that's a fly in the ointment. I think people thought it was, but I don't think it is. So I think
Mhm.
really the risk factors are all inflation related, and right now those are calming. Those are not flies in the ointment right now. In the future, we talked about it last week. It's going to be the IPO market when things get too greedy, too heated up, too there's too much FOMO out there. We're seeing
Right.
more and more IPOs. We are like the IPO market is getting busy, but it's not relentless right now. You don't have that fervor that you did in '99. I think we will get there. We will get there. So that's something you got to watch. But as of right now, I think things are at a good level, at a good state for the markets to blast higher in the next 6 to 12 months.
Gotcha. So nobody's frothing at the mouth just yet
I
in
don't.
the
I don't
IPO
think so.
market.
I mean, I think
Yeah.
somebody came out with a research note today that said this is the most hated stock market rally of all time. I love that. I
Hmm.
love. I love when people hate stock market rallies because what do stocks do best? Climb walls of worry. Right. So long as
Right.
we're climbing a wall of worry, that's good. And that's why I also like about AI. There are so many skeptics out there right now.
Hmm.
Everybody seems to be skeptical about AI. Technological progress also climbs walls of worry the best, right? It's when everybody buys in that you got to be worried. When everybody buys into the stock market and says it's going to go higher forever, head for the exits. When everybody says AI is going to change the world, not just me, but when all the pundits and skeptics join me in that chorus, that's when you head for the exits. Okay, that's
Right.
that,
Right.
that's a time to worry. And then you have a reset, and then you buy the dip on the other side. We're gonna get to that, but we are not there yet. There's still so much skepticism out there, too much skepticism for there to be a bubble popping moment.
Gotcha. Now, I do want to highlight a specific sector of this breakout. Pretty infamous, Cathie Wood's Innovation ETF. I know you've had some interest in its breakout recently. Could you expand on that?
Yeah, let's pull the chart on that real quick. The ARK ETF. So I think this is a huge breakout. First, let's talk about the breakout and let's talk about why it's
Yeah.
important. So, Cathie Wood, ARK Innovation ETF, they invest in these early stage hyper growth stocks. It was a poster child of the 2020, 2021 stock market boom, and then it got crushed. And it really hasn't made a comeback ever since until today. So if I look at this chart, okay, this is the ARK Innovation ETF. As you can see, 2020, 2021. I mean, look at that. It went from a low of 35 March 2020, high of 156 February 21. So basically, we'll call it, to make the numbers easy, 30 to 150, a 5xer, okay, in 2020, 2021. Massive growth. Then we had the big breakdown, okay? But now look at this. The level I've always said is right here. Or not right, is right around here, okay?
Okay.
To me, this is a big level because this was a level that, okay, we lost it here. Actually, let's go right here. This is a big point. We lost it right here. Okay, this is what I'm going to call 67. I have it 66.33, but let's just call it 67 for round number purposes. Okay, we lose it here in early 22, and then we try to retake it. We barely do, and then we lose it again, and then we just languish below it forever. Let me emphasize this. Let me make it width of 3 in big red so you guys can. It really stands out. Now it really stands out. Okay, so we lose it. Try to retake. We fail. We languish below it for years. We try to retake it on the Trump victory, early 25. Boom.
Hmm.
Sorry. Hit our head and fail because of the trade war. Oh, but now we're coming back, and look at this. We knifed through it. easily knife through it. Now we're at $70 on the ARK ETF. This is a breakout in my opinion. So one of the big, theories that I subscribe to is stage analysis. A stock at any point is in one of four stages. Stage one is when it's consolidating at a low level. Stage two is a breakout. Stage three, consolidating at a high level. Stage four is a decline. So if you look at the ARK ETF, what I see here is okay, we have a stage two breakout here. Goes vertical. We have the stage three topping pattern here in 21. Then we get the stage four breakdown here in 22. And then we were basically in a stage one consolidating pattern throughout 22, 23, and 24. And then here in 25, I'm seeing the beginning of a stage two breakout, similar to the beginning of a stage two breakout we saw in May, April of 2020. This is a breakout on ARK. I think ARK is about to go parabolic like it did during 2020, 2021. That's interesting because maybe buy ARK, that's cool. But it's more interesting in what it says about the market, okay? Cathie would invest in those early stage, hyper growth, risk on stocks that do well when the sentiment is super risk on, when investors are feeling really good about the economy and about the markets, and they're like, you know what, it's time for me to look for the next big thing. It's time for me to get some FOMO. It's time for me to get greedy. It's time for me to find, a potential 10xer or 20xer and go really out on the risk spectrum. That market sentiment is when the ARK ETF does really well. Think about 2020, 2021. Risk sentiment was so high, it was so positive, so strong. Everybody, remember all the altcoins and the NFTs and all the millionaires that were being made. And everything was going boom, boom, boom. All the SPACs, everything was just going through the roof and parabolic. And it was the biggest bull markets biggest bull markets. It was unreal. That's when the ARK ETF had a major breakout. That's when it was in a stage two breakout. The fact that it looks like it's getting into a stage two breakout again tells me that we are getting into maybe the first or second inning of that sort of market again. That real risk on market. Now, of course, that's a yellow flag too, because stuff like that doesn't last forever. Look at 2020, 2021. You had a big boom for, call it 2 years, year and a half, and then you had a massive crash on the other side, a massive reset. So when you kind of add all this up, okay, the AI boom is heating up. A lot of parallels with the dot-com boom. Rate cuts are coming. They're going to juice things up. You have risk-on sentiments looking like, it could mirror risk-on sentiments of 2020, 2021. What that tells me is that second half of 25 and 26 are probably going to be like these parabolic hockey stick years. It's going to be crazy. There's going to be a lot of winners. You're going to get a lot of risk on stuff. You're going to see small cap stocks go up 10x, 20x, 30x. You're going to see the big boys continue to lead the way. Big gains out of them, 20%, 30% per year. You're going to see a lot of very good stuff in the stock market for the next 12 to 18 months. And then we are probably going to pop. Right? That's what I'm seeing shaping up right now. And it's exactly what I thought would shape up when Trump came into power in late 24, because it was like his pro-growth policies, his deregulation, his tax cuts, all that stuff, it's going to unlock the economic engine. Yes, but the economic engine eventually gets too hot. And when it gets too hot, it comes off the rails. And when it comes off the rails, everything busts. When you combine that sort of deregulation, pro-growth policy set with this AI fervor, you combine essentially, the massive deregulation of the 80s with the dot-com boom of the 90s, it's going to lead to a big bubble eventually. So that's my outlook. 12 to 18 months, I think we roar like crazy. I think it's going to be the biggest gains yet. And then we probably hit a peak, and then we pop maybe in 27 or 28. So that's how I'm looking at things. I think a lot of the ARK ETF is very representative of that. It's a microcosm of that. But right now it's $70 on this breakout. I'd be a buyer of ARK. I would be. I think ARK can go to 160 now. I think ARK can do a double or triple from here, and then probably a repeat of the 2022 crash. But a lot of money to be made in the interim. So that's why I think people should be following and definitely watching, if not buying, the ARK ETF.
Excellent. Okay. For the past couple of years, it's had a pretty harsh negative reputation, but it does seem like all the indicators are positive with everything else going on. Now, I do want to get into technology. Tesla just dropped the Robotaxi. Finally, it's happened. It started in Austin.
Mm-hmm.
However, I do want to get your opinion, but I do think it kind of feels like it's a little too little too late because Waymo is just way too hot right now. What's your opinion, Luke?
Yeah, so I mean, it's good news, right? It's good that they launched Robotaxi. Like finally, they finally did
Yeah.
it. Long overdue, 10 years in the making. I'm happy for them. I'm happy for Tesla stock. It's good, but there were hiccups. There's a lot of video out there and footage out there of,
Hmm.
the rides not being so smooth, of the Tesla cars making mistakes. And that's to be expected, right? The first time you do anything, there's going to be mistakes. Waymo makes mistakes, okay? That's fine. Mistakes are fine. I'm not knocking them for the mistakes. But I think it's going to be really hard for them to catch Waymo. Really, really hard to catch Waymo in the Robotaxi game. I love Tesla as a play on passenger self-driving cars. That I think the self-driving revolution, there's going to be three big verticals which emerge: autonomous ride sharing, autonomous cars, and autonomous freight. And I think when you look at the autonomous ride sharing market, Waymo's doing, I mean, as of I think it was April or May was the last update, 250,000 rides per week. Given their growth rate, they're probably at 300 to 350,000 rides a week right now. So this is a company that's doing over 300,000 rides a week. They're in multiple metros. They just launched in Austin or Atlanta, Georgia with Uber. They just applied for permits to go to New York City. They just expanded the driving range in California by 50%, radically expanding the range in Los Angeles and San Francisco. They dominate where I live in Phoenix, Arizona. So it's just going to be really hard to catch them, especially because they're in cahoots with Uber, who has the biggest ride sharing network out there, and that's valuable because you immediately plug into an application that essentially everybody has, right? If you are a person that lives in a city under the age of 50, you probably have Uber downloaded on your phone. And if Waymo is going to partner with them to serve rides, then all you have to do is use the app that's already downloaded on your phone to get into an autonomous Waymo, right? So there's a lot of reasons why I think Waymo is going to win the autonomous ride sharing game. But I love Tesla as the winner in the autonomous car game. Not providing autonomous
Right.
rides per se, like Robotaxi, but selling you an autonomous car and then having a small scale Robotaxi network that operates amongst the Tesla car owners. And so I think that's a huge market. I think then they can sell the cars at relatively low margin and then make up for it with high margin software sales servicing that full self-driving software. And so I think that's really margin accretive to the business. I think it's going to really scale profits nicely. And it's going to grow very quickly. So I'm actually very bullish on that. And that's why I think that the launch of Robotaxi, regardless of its hiccups or delays or whatever, is a positive for the stock. And I do like Tesla as the winner of the autonomous car game, not ride sharing, but autonomous car game. And then you have autonomous freight. And on autonomous freight, we got Aurora. They're the ones doing self-driving trucks. A lot of companies were doing self-driving trucks, but ditched that effort because it's pretty hard. Aurora doubled down on it. Now they're the only ones out there really doing it. They have autonomous trucks on freeways in Texas. They have a great team. They have a lot of talent. They got a lot of funding, really good backers. I think they're going to win the autonomous freight game. So that's how I see the autonomous driving revolution playing out. Three big verticals, three big monopolies: Waymo with Uber, Tesla, and then Aurora. So that's how I like it. That's how I'm viewing the robotaxi stuff. And I think it really is a step in the right direction for Tesla to dominating that second vertical, the autonomous car vertical of the autonomous vehicle revolution.
Gotcha. I do have to ask, since we're talking about the technology, Waymo has the LiDAR and Tesla is camera only.
Mm-hmm.
Do you see that as a hindrance in the future? Do you think Tesla will ever branch out into more LiDAR capable vehicles?
Yeah, I think LiDAR is necessary.
Right.
At least in the next like 5 to 10 years. Like maybe like the play on cameras is that AI gets good enough that you
Mm.
can do it with just cameras, and maybe in like 10 to 15 years that is true. But I, for safety reasons alone, like redundancy just makes a lot of sense. And LiDAR is not that expensive. It's like less than $500 really. If you go to like a really cost effective maker like Hesai, that's a stock that's been doing really well, ticker HSAI. I mean, I think they're getting LiDAR out there for 200, $300 a pop. So I don't see why you just wouldn't add it on, right? Like add on a few LiDAR and you add on $1,000 to the cost of the car. Like a car is a $20,000 vehicle, a $25,000 vehicle, a $40,000 vehicle. Like what's adding an extra grand there if you're improving safety dramatically through redundancy? I just think it's a good thing to have. I
Right.
get the optics that it can be kind of ugly. The Waymos aren't exactly ugly, but they're going to get smaller. And I think they're going to fit really seamlessly into the design of cars. So from that perspective, I think LiDAR will prove a crutch for Tesla in the short to medium term. Maybe in the long term, it actually proves a tailwind because AI does get to a point that they can obsolete some of these other sensors. But I do think we are a long ways away from that, and there is a reason why pretty much everybody else in the self-driving space outside of Tesla is using redundant sensors like LiDAR and radar and all these other sensors. So yeah, I do think right now it is a crutch, and that's one of the reasons they
Yeah.
won't catch Waymo in the ride-sharing game.
Gotcha. Yeah. Tesla's probably the only company that can wait out for AI to get that strong, right?
Yeah, I don't, I mean, I've always been really hopeful that they would just throw LiDAR on, because Tesla has the
Mm.
best AI in the game, in the self-driving game. I think the only thing that's holding them back is the fact they don't have LiDAR. So like if they threw LiDAR on there for a couple $100 and then teamed it up with their best in class AI, they could win all three verticals. Right? Like
Right.
that's how they could dominate everything. I like there's just some like ego thing or some stubbornness against it, and I don't, yeah, I view it as unfortunate, but I think it's an opportunity for other players, so long as they continue to turn the cold shoulder to LiDAR.
Gotcha. Okay. So now on from vehicles to health. I want to talk about Novo Nordisk, the biggest company in Europe, and they just cut ties with Hims and Hers.
Right.
I want your take on that, Luke. I know you were a big proponent of Hims and Hers.
Yeah, let's look at that Hims stock chart real quick. I mean, Hims and Hers has been a massive winner. Like the story here with Hims and Hers is that they were, but as you can see, this is the nosedive on the Novo Nordisk ended partnership.
Yeah.
Well, let's zoom out and just look at the big picture here. The story on Hims and Hers was they were going to transform healthcare. They were one of those SPACs back in 2020 during those really good times for the markets, right? They're one of those SPACs, and the story here back in late 2020, early 21 was they're going to transform healthcare and be the new front door for healthcare, right? So as opposed to going
Hmm.
to a healthcare provider, as opposed to going to your doctor, as opposed to having it all be in person and slow and antiquated, that they would do this all through an app. And I love that idea. I
Right.
love the idea of Hims and Hers transforming into the new front door of healthcare. I think it's a really good idea. It's a space that needs disruption, technological disruption. We access everything else and buy everything else through our phones and through applications, mobile applications. So why can't we do that with healthcare stuff? Especially if we integrate AI into it. It's like we can have AI personalize a lot of our healthcare treatments. We can have really accurate surveys and things like that to diagnose what's going on. We can use computer vision where you take pictures of something and it can help you out there. So I just think like there's a lot of reasons why that's a great idea and why it should work. Now, Hims and Hers kind of fell into a weird corner of the market where they started going after ED. They started going after sex
Mhm.
stuff. They had hair loss and sex stuff. And they kind of fell into that weird corner, and then the market kind of lost hope in them. They're kind of like, okay, you're just going to be like this little niche provider of, you know, not obscure, but like a smaller market of drugs and treatments, mostly
Right.
oriented towards men. Um, and that's why the stock crumbled, right? You see 2022, 2023, I mean, it kind of stayed below that $10 SPAC price and stayed pretty weak, but then it got into the weight loss game. Okay. Then at first it dominated in the hair loss and in the sex treatment game. And then it started to expand. And then it got into weight loss and got into mental health and other things. And then it really started to transform into the front door of healthcare. And that's when you saw the stock take off from $6 all the way to what the high is $70 essentially back in February 25. You got that massive rally because all of a sudden the front door of healthcare thesis started to really come to life. And then it took a massive shot in the gut yesterday when Novo Nordisk ended the partnership and said, you know what, you guys are not acting in good faith here and not really taking care of people, and you're pushing these kind of generic GLP-1s, and they're
Hmm.
not safe. And so then they ended their partnership, and now we're down from 64 all the way down to 42. Now the Hims and Hers CEO has come out and said, "Yo, that's not what happened. What happened is Novo was really pushing us to offer their weight loss treatment, Wegovy, over some other GLP-1s, and that because we weren't willing to do that is why they ended the partnership." So, I mean, there's two sides to every story. I don't really know what's going on. I didn't really dig into it too much, but what I do know is this: weight loss drugs are a massive thing. Massive. I think that market's going to be huge. Hims and Hers has a really good platform that I think beyond weight loss drugs can service a huge number of people and transform how we get access to over the counter medicines. And then number three, Americans like cheap, right? I think that we're going to get a lot of generics in the GLP-1 game, in the weight loss game. And I think we're going to get those generics at really low prices. And I think Hims and Hers is going to be a platform to get a lot of those really low prices with really low friction. And that's going to be a huge growth unlock for this stock. So I think that the sell off is a bit overdone, if not way overdone. And I think that this stock is going to go a lot higher. I think this is a potential big time, long term winner. Asterisk, asterisk, asterisk. So long as what Novo Nordisk is saying is not true. Like, if indeed there's some sketchy stuff going on at Hims where they're not really looking at the safety efficacy or the safety ratings of a lot of their drugs on that platform, then that will come back to haunt them and bite them and destroy the company. Absolutely, 100% sure. But in terms of this tug of war between Novo and Hims, based on what I've seen so far, I'm kind of siding with Hims in that it seems likely that Novo was trying to push their own medicines, and once they realized they couldn't just unfairly bully their way into distributing their medicine exclusively here, then they backed out of the partnership. That makes sense. That makes a lot more sense to me than Hims and Hers is not looking at safety ratings. So I think we're safe on that front, and if so, then I think the stock is going to be a big long term winner.
Gotcha. Yeah, I mean, I am curious that you think there is way more runway for these GLP-1s. I know, I mean, Novo Nordisk got huge in the span of a couple of years based on the, the Wegovy, Manjaro, I think. So you think with the generics, there's still a lot more runway left in that particular sector?
Yeah, I do. I think that I think there's a huge movement towards healthy, at least aesthetics, like the appearance of healthiness, right?
Correct.
I don't know if there's an actual push towards being healthy. I don't think people want to do that much research and work into looking at ingredients and all that stuff. I think some people do, but I don't think that trend's ever going to get that big. That's just too much work. But you tell me I can take a pill once a week or an injection
Hmm.
once a week or once a month, and I can get skinny and look good. Yeah, like I'm going to do that. You know, like it's easy, it's convenient, especially when you get to the oral formulations, right? Like a lot of people don't like the injections. Okay, and I get
Yeah.
that. But like as soon as you make it as easy as taking a pill, like taking a vitamin once a week, then why? Yeah, the market there is massive. Who doesn't want to like lose some weight? Whoopsies, lose some weight and be skinnier and it look better. Like that's yes, I think the market there is huge, and I think that
Mhm.
even if you do preventative things like working out and all that stuff, that doesn't change the fact that there's a massive portion of the population that's um, the ship on that has sailed, if you will, right?
Right. Yeah.
Like once you gain a lot of weight, it's really hard to lose that weight. It's much easier to start off smaller and stay small as opposed to gaining a lot of weight and then losing it. Like that's a real effort. That's really hard to do. People who do that, massive congratulations. Like that is a tall task. And I think because it's such a tall task, it creates a huge opportunity, huge want, huge demand, huge desire for these GLP-1s, even beyond what we've seen, the growth we've seen so far. And the market's doubting that, right? Like names like Eli Lilly
Mm.
and Novo Nordisk, they got hot and then they cooled off. I think a lot of that is the Maha movement, Make America Healthy Again. RFK Jr. Is not. I don't know if he has directly attacked these, but he's definitely not like pro Ozempic and pro these drugs, right? So I think there's some fear about political headwinds, but I think ultimately this space is going to be huge, and I do think there's going to be a
Right.
lot of winners that emerge. Novo Nordisk, Eli Lilly, these stocks have been just bludgeoned, and I think they're probably dip buys.
Gotcha. It's funny. I've heard talk about certain food companies trying to create craft formulations for foods that can overcome GLP-1s. So that'll be an interesting battle to watch in the future.
Yeah, yeah, we'll see, right?
Right.
Corporations will figure out a way to make money somehow.
Somehow. So now, speaking of corporations, I do want to talk about AI and insurance. There's a couple of
Hmm.
companies like Lemonade and Oscar. I want to get your
Yeah.
take on those too.
Yeah, I think so. When I think about where AI can make a big difference, I think insurance is a big one, right? Insurance is
Mm.
a lot of data cranking, a lot of number cranking, crunching, and that's where AI excels. So when you think about what Lemonade does, that's super cool. Like their AI head to toe. I didn't really realize until I did a deep dive on them recently that they are AI head to freaking toe. Whole AI, whole organization, right? So from I'm interested in a policy, help me out. They have an AI chatbot. You go to their website, it just kind of walks you through it. Here's a survey, questionnaire, answer some questions, uses natural language processing to guide you through the process and get you to, um, you know, to a potential policy. Then it has AI crank through your numbers, your data, your analytics to price the policy. So it's like, AI at the top of the funnel entirely. Then you move down the funnel. Let's say you sign the policy, you're with it, you got it. Okay. Now you got questions about the policy. Well, they have AI chatbots that are addressing those. So middle of the funnel, AI. Bottom of the funnel, now I got a claim. Okay. I got in an accident and my pet had an injury or whatever it may be. Now I have a claim. They're resolving, I think the number was 40%. 40% of all of their claims are being resolved within minutes through AI. Like you just take a picture or a video or follow a simple questionnaire with their AI, and then boom, the AI is able to resolve the claim and pay you out in minutes. Like I think the number is 40% of their claims are paid out in that fashion. That's crazy. The amount of fighting that people do with
It's
insurance
nuts.
companies to get paid out. And even if there is no fighting, just the bureaucratic process of trying to get it paid out, it still takes weeks, if not months. Like the fact that this company's figuring out how to use AI to do it in minutes, that's disruptive. That's massively disruptive. And so when I think about Geico and I think about State Farm, I think about Allstate, I think about all these big boys, it's like you guys better start using AI a lot more, or you will be disrupted by the company that is doing it. Because here's the thing: Americans are going to go for cheaper policies. If
Mhm.
indeed Lemonade can remove substantial overhead by using AI, then they can price policies substantially lower. Let's say they remove 50% of their overhead costs at a similar scale as an Allstate or Geico. Then they can price policies theoretically 50% lower. And then Americans are going to shift to those policies. And then State Farm and Geico are going to be like, oh crap, we're losing market share to this AI player. How do we get our costs lower? And then, the engineers are going to be like, well, the only way we do that is we, reduce our overhead. And then boom, all of a sudden they're reducing overhead and they're using AI. So I think the AI disruption wave in insurance has arrived. Lemonade's a tip of the spear. And whether or not they become the big kahuna in the space or not is going to be dependent upon how quickly the big boys react to their disruption. Right now, I think the big boys are
Yeah.
reacting pretty slowly, and that's why Lemonade is seeing such big and sustainable growth. That stock's also been on a heater. Pull up the chart for it real quick. And I think it's got room to go. It's still pretty cheap. It's a big time growth story. Um, yeah, I mean you can see that it's kind of had this big move. It's one of those that languished in nowhere for a long time. Had that big 2022 collapse. This is kind of like him. It's big
Yeah.
collapse, stage one basing, and then now we're having a big breakout, right? We're up from 15 to 45 in what? A couple months. So Big time rally. I think this one it has a lot more runway left in it. AI and insurance to me feels like a big disruptive wave.
Yeah. I mean, it feels like the right move would probably be an acquisition by one of the big boys just so they don't even have to worry about the competition in the future, right?
Yeah, so Lemonade is just focused on personal lines right now. I think if they get into
Yeah.
business lines, then that would make them an attractive acquisition target. I think in personal lines, because the AI algorithms are going to be fundamentally different from personal lines to business lines, I think that doesn't make them a super attractive acquisition target.
Right.
But if they do get into business lines, which I think they should, then that will make them a really attractive acquisition target. Absolutely.
100%. Yeah, that 40% number damn near almost sold me because I mean, I think most Americans have had to run into insurance, and you got to wait for this guy to talk to this guy, and then you got to send this email to this place. And if you can just circumvent all of that with AI, like, why wouldn't you, right? That's
That is exactly right. That is exactly right.
yeah. Now, I do want to talk about robots today as well.
Okay.
You're pretty bullish on those. I think we've talked about those before. It looks like rare earth magnets are going to be the rage in the next few years. How do we play that? How do we play robots?
Yeah, so yes, now we're talking about the robo supply chain, right? So, um, one thing that I think of is like, okay, electric vehicles back in 2020, 2021 were all the rage, but the companies that actually did super well were like the suppliers of electric vehicles, right?
Mm,
Like whether it was lithium metals or batteries or solid state battery makers, right? Like those were a hot ticket back then. Now, I do not think that the AI trend or the robotics trend is that similar to the EV trend because I think the robotics trend actually has a lot more the addressable market's a lot bigger, and I think the runway's a lot longer. But I do think that this theme of like, if a big tech trend is emerging, one of the best ways to play it is through the supply chain. Yes, that's the commonality. So, what's the supply chain of robots? Well, if you go all the way to the base level of the supply chain, it's rare earth magnets, okay? Because robots, humanoid robots especially, they need a lot of motors
mm,
because every time they're moving a wrist or they're moving an elbow or they're moving a shoulder or they're moving a leg or whatever it may be, those are motors that are turning electrical energy into mechanical energy, right? Electrical energy fires to those motors and then they convert into mechanical energy to actually move the robot. Well, what turns electrical energy into mechanical energy? Magnets. That's exactly what magnets are supposed to do. They turn electrical energy into mechanical energy. Huge physics discussion. We can have it about it. Don't need to have it. What we need to know is that magnets are in motors and motors are in robots. So the base level of a robot, of a humanoid robot, is going to be the magnet. Now there are a lot of types of magnets, and I'm not talking about the magnets you played with in school when you were in elementary school. I'm talking about rare earth magnets. Those are the most powerful magnets, the most energy dense magnets. You can make them super small yet super powerful. Rare earth magnets. So when it comes to making magnets, their supply is rare earth metals. So if we're looking at robotics, we have the whole supply chain. At the very first step of the supply chain is rare earth metals. If we do get a bunch of humanoid robots in this world over the next 5, 10, 15 years, it is going to create substantial demand for rare earth metals. That's a problem because 90% of the rare earth metals in existence today come from China. We have
mm.
a huge dependency. Everyone has a huge dependency on China for rare earth metals. Not great. Not great to be reliant on your number one tech competition for the number one material you need to build arguably the biggest piece of that tech competition, robots. And with the Trump, policy of America first and make America great again and make it in America, we don't want to be sourcing the stuff from China. So we need to find a way to make some or find some rare earths here in America. And there are rare earths here in America, and there are a few companies that are doing that. MP Materials is one of them. Let me pull up the stock on that one because that one too has been on a heater. Now they have a completely vertically integrated rare earth magnet supply chain here in the United States. They got a rare earths mine, they got the refining, they got the magnet construction. They do it all. This stock, IPO, big hype, big crash. Now all of a sudden it's starting to get some life again, right? We've gone from $10 to $35 in the span of about a year, a little bit less than a year, from $10 to $35. Huge rally. Biggest rally has come obviously on the heels of this trade war, realizing, oh my goodness, geopolitical tensions are rising. US is not going to be able to rely on
Right.
China. We need to find alternative supply chains, especially for critical stuff like rare earth metals. MP has become a darling on Wall Street from 18 to 35. Another play here is USAR, more speculative, much smaller. They haven't really started their mining. I believe the facility's in Texas. They're still doing an evaluation, economic assessment of it to see how valuable it is and all that stuff. But this is your more speculative play on it, USAR. I don't like it as much. It's too speculative for my taste. But MP, I don't think is going to be a 10xer. USAR could be a 10xer if things work out there well for it. So this is a new industry that I'm kind of coming into, learning about, as I'm digging into more and more about robots. I love supply chains for emerging technologies, rare earth metals, very underdiscovered thing here. Now another one actually is TMC. They do like that underwater mining stuff. Have you heard about this?
I don't think I have.
Yeah, so they develop these machines that go underwater and mine essentially international waters and pull out valuable things like rare earth metals potentially. And I mean, look at this stock, right? This was a sub-dollar stock. It was 70 cents around Christmas. 70 cents around Christmas, and now it's $7 around around some July 4th. So half a year, 10x. That's crazy. TMC
That's
could be
fair.
big time. I don't like the idea of mining underwater and the undersea stuff. It's tough for me to like wrap my head around it and actually like it and think it's going to be big. But apparently I'm wrong. The market thinks it can be big. Like I said, 70 cents is $7. That's another play on this whole kind of like, metals resurgence, in America.
If we're going strictly off the numbers, I think only 5% of the deep oceans have been explored. So if TMC keeps expanding, that's a lot of runway, right?
Isn't that freaky? That
It's
only
scary.
it's really scary. I don't know if it's 5% or 10%, whatever.
Right.
That's every time I'm on like a cruise ship or something or out there, and I'm like, what's beneath us? Well, nobody really knows.
Yeah, it's hard to think about sometimes. Cool. Um, so we talked about MP, TMC, and the third one was
USAR.
USAR. So now I do want to move on to our exponential stocks of the week. I want to pick it up with Circle. We talked about them already, but there's always a reason to talk about Circle.
Yeah,
The
I mean
stable coins give it
it's
up.
the stock that won't give up, right? Oh, I guess it's given up today. There you go. Finally, we have a downturn. The first red day for the stock since its IPO. This was a $31 IPO, people. It got to 263, 31 to 263 in a matter of a couple days. That's ridiculous. This one's been red hot. Stablecoins are just going everywhere. Fiserv is getting into the game. MasterCard, I think, is getting into the game. Visa is getting into the game. So stablecoins are just exploding in popularity. They are definitely going to infiltrate the payment ecosystem in America. Circle is a tip of the spear here. The stock is just way too hot to touch. Anyone that's chasing it here, I mean, it's short covering. It's pure momentum. It's pure sentiment. This is not a
Right.
fundamental trade at this point. You got to let it come in. But I think if it does come in substantially, and this is one that could give up 50% or more. Again, 31 was the IPO price. We're at 230. Even after a big down day right now, we're still at 230, way up from that IPO price. We come into the hundreds, low hundreds. That's probably an opportunity to buy the dip in this name.
Gotcha. All right. And then we got Rocket Lab up next.
Oh, I love my good old Rocket Lab. Good old Rocket Lab. Yeah, so this is the SpaceX alternative, right? They do the smaller rockets. SpaceX focuses on the big boy rockets. This one focuses on the small and medium rockets, smaller payloads, more frequent visits up to space. I think it's odd. One, I like it just because I think space is an exploding investment opportunity right now. Two, Rocket Lab is the big second fiddle in the space behind SpaceX. Three, it's the only really publicly investable one. DXYZ is one way to backdoor into SpaceX, but SpaceX is not public. Rocket Lab is public, so it's pretty much the only pure play public space rocket launch company. And then four, I mean, if Elon Musk and Donald Trump continue to have their tiff, I don't know what the status of that tiff is, but it probably means less contracts for SpaceX and more contracts for Rocket Lab, the only formidable competitor to SpaceX. Now, this stock has been red hot, and I think it keeps going. The fundamentals here are absolutely fabulous. I mean, when I look at let's just pull up the model on it. This is one where the numbers are as good as the stock chart. The stock chart you saw is super pretty, but you look at the numbers on this one. Revenues up 33% this year, up 53% next year, 37% in 27, 26% in 28, 28% in 29. I mean, this is a consistent 25% plus revenue grower on the top line. Fantastic. Gross margins expected to go from 35% this year all the way up to 45% by 29. So 10 points of gross profit margin expansion. EBITDA margins really low right now, minus 14%, but because of that 10 points of gross profit margin expansion and because of this sustained rapid revenue growth, economies of scale unlocks positive operating leverage. You go from minus 14% EBITDA margins to 30% EBITDA margins by 2029. And then EBITDA itself goes from minus 81 million to 578 million. So when you talk about the growth story here, free cash flow goes minus 200 million to 430 million. When you talk about the growth story here, the chart looks pretty, the numbers look great. I really do like Rocket Lab. I think it's a great long-term stock.
Gotcha. I do think Elon threw up the white flag in their TIFF, if I'm not mistaken. So,
I do think so, but I mean, hey, it's kind of like the Iran-Israel thing. It's probably never going to end, right? So there's
right.
going to be back and forth, and then they're buddies, and they're not buddies, and then they're throwing Epstein accusations. You know, it's just going to
Mhm.
fly left and right. Okay, so I don't think that that tailwind for Rocket Labs can disappear anytime soon.
Gotcha. Let's go on to the next one, Oscar Health.
Yeah, Oscar Health, another kind of like healthcare insurance tech play. I'm not a huge fan of this one. Like I do think there's a great story here. I do think that it's fundamentally really undervalued, but it's very memey. Like the meme crowd on Twitter, on X, really got a hold of this one, and that's what sent it from $11 to $21. I don't like when the meme crowd really gets a hold of things because
Hmm.
then all of a sudden the price detaches from fundamentals, both on the upside and the downside. So you can get a massive upside swing detached from the fundamentals and a big downside correction
Right.
detached from the fundamentals. So this one had a big upside swing. I think maybe it's time for a big downside correction. Once the meme crowd washes out of this one, there's probably an opportunity there. But right now, I do not like the over involvement of the meme crowd in this name. But again, I think the story is good. The numbers are good. The valuation's really attractive. Um, well, I think we got a 20%. Yeah, I mean, 23% grower this year. But profit's not really going up too much. So the numbers are good, but not great. That's why, again, I wait for the meme crowd to kind of wash through it.
Gotcha. You're not a fan of the diamond hands, Luke? It's not your bag.
I'm a fan. I'm a fan of Diamond Hands on good stocks.
Right,
Diamond
right.
Hands Meta, Diamond Hands Microsoft, Diamond Hands Axon, Diamond Hands Palantir, Diamond Hands really high quality stocks, absolutely, but not Diamond Hands GameStop.
Gotcha. All right. Next one we got is Zeta Holdings or
Zeta
Zeta
AI
Global.
marketing. Yeah, I like this one. I think this one it got hit by a short report, but now it's bouncing back. Um, I this one was a big time winner. as you can see, for a while, and then got hit by a short report and never really recovered, lost a lot of ground, but now it's starting to regain some momentum. They do AI marketing. I think the business is legit.
Yeah.
I don't think it's a black box. That's the complaints about it. It's a big time grower, very attractive margin profile. I think the AI capabilities are very legitimate there. I think they're helping companies market very innovatively with their AI. It reminds me sort of like uh, um, an app lovin' a little bit, which has been a massive
Gotcha.
winner. Reminds me kind of a little bit of that, a little bit early stage, more intelligence oriented than marketing oriented. But still, I think they provide some really good insights. I like their AI. I think they're in the right space. I think the stock's ready to bounce back.
Interesting. I do got to ask. Meta is getting into heavy into the AI marketing.
Yeah,
Are these two different market shares, or would Meta just completely crush Zeta?
Zeta's more on the intelligence side of things. They provide more intelligence than marketing solutions. AppLovin is more marketing, so I think the risk of Meta in-housing a lot of their advertising is more of a risk to AppLovin than it would be to Zeta. But AppLovin focuses more on outside of the walled garden. They're not trying to get ad share within the walled garden. So within the digital advertising space, there's the walled garden, which is the big platforms, Meta,
Right.
Google, those big boys. Then there's outside of the walled garden, which is advertising on all the other places on the internet, whether that's mobile apps or news places, whatever it may be. If you're focused outside of the walled garden, I think you're safe. If you're focused on in the walled garden, you're not so safe. AppLovin focuses outside of the walled garden, so I think they're safe from the Meta disruption. But I do think that's going to be a massive disruption. If Meta in-houses all of the marketing with AI, yeah, that is going to have massive ripple effects across
Right.
the ad ecosystem.
Okay. So still a safe bet for now.
Yeah, Zeta, I don't think is really impacted by that. Like I said, they're more intelligence oriented, and then AppLovin may be impacted by it, down the road, but not now.
Gotcha. Okay. And then last but not least, we have Applied Optoelectronics.
Yes, this is one of this is an AI builder. It's not in our AI Builders 15 index, but it is an AI builder that we do like, that we think has a lot of potential. This one too, big rally, washout, now the return rally, nice little comeback. Networking equipment, opto equipment for data centers, AI hyperscaler wins on deck supposedly. I think they're going to scale real nicely. I think this one has big time growth potential. I mean, look at the numbers. Again, as the AI builders boom just kind of rolls on, there's going to be a lot of players like AAOI that get some of that money. When hundreds of billions of
Mm,
dollars flow into the top of the funnel and you're just in the funnel, you're going to get some of that money, especially if you're well positioned. And I do think AAOI is very well positioned. Look at the growth numbers here. 92% revenue growth expected this year, 54% expected next year. Gross margins are from 31% to 34%. EBITDA 23 million to 50 million, so a doubling essentially in EBITDA. This is a big story. This is a big time growth story. I think this one can keep going, as I expect more AI hyperscaler wins in the next few quarters, and that should blast the stock even higher.
gotcha. Yeah, just another indicator of the ever growing AI market, right?
Ever growing, man. Ever growing.
Cool. And now that wraps up our exponential stocks. I want to talk about lifestyle. I want to bring up something we talked about in this episode, and we kind of just talk about almost every episode. Just self-driving cars. How do you think that's going to look in the future? For the everyday person, what is that going to look like for the lifestyle of, let's say, the average American?
Okay, so one, I think car designs change. I think Tesla's very innovative with the cyber cab and cyber that what's the other one called? Not Cybertruck. It's a cyber cab and oh man, I forget. Cyber van, cyber cab, and
Right.
cyber van. I think those designs that's the future, right? They're
Yeah.
gonna look less like cars, and they're gonna look more like living rooms on wheels, right? So you're gonna have like
Yeah.
couches facing each other, and you're hanging out. I think even the cyber cab is a bit that'll be obsolete within 5 years because they still have people like facing forward. I think people are gonna want to face sideways and like couch style living. Like basically, you take that platform and you make it a living room. That's what I think. So I think car design changes fundamentally. That's a lifestyle shift. Two, as a part of the car design changing dramatically, the way you use cars and what you do in those cars is going to fundamentally shift. You're going to work in these cars now, right? So here's what I think. I think right now, people drive to work. It takes 30 minutes, an hour to drive to work. Then you put in your 9 to 5, and you got a 30 minutes hour back home. So let's just assume 30-minute commute time. I think that's a national average. You're not really doing 9 to 5. You're doing
Mhm.
8:30 to 5:30. Okay? And those back end 30 minutes, front end and back end 30 minutes, are not used for working. If you instead take that hour and you use it to working, your 9 to 5 can shrink to 9 to 4. If your commute is an hour each way, your 9 to 5 can shrink to a 9 to what? 3? So all of a sudden, you can shrink work days. Or if you keep work days the same at 9 to 5 and you save an hour every day, maybe Friday all of a sudden doesn't need to be a work day. So I just think that it's going to give so much time back to people because you don't do anything while driving a car besides listen to podcasts, which really not super productive or helpful, even though I like our podcast.
Right.
Um,
Listen to Being Exponential.
yeah, listening to music, talking on the phone. People aren't really using their time super productively in cars, nor should they. They need to be focused on driving. But if the AI is driving the car, then you can be productive in the car. And there's so much time spent doing those things, driving, that, yeah, it's going to give us so much time back. So now we're going to start watching or doing our work in our cars. And if you put AI glasses on that, all of a sudden, one of the big limitations of working in a car, people might say is, oh, well, I have my multiple monitors at work. I have my, my left monitor, my center monitor, my right monitor, and I have all these features. Well, and I can't do that on a laptop. Well, if you have AI glasses where it's like holographic and all of a sudden you do have multiple monitors running and it feels like you're working at a desk, you're going to be hyper productive even in the car. So I think it's going to give a lot of time back. Number 3, it's going to absolutely destroy people that drive for a living.
Mm.
Uber drivers, truck drivers, taxi cab drivers. I really don't see why they need to be around in 10 years. I do think that those drivers get completely obsoleted in 10 years. So that's a big negative growth shock to the economy, to the labor market, as you're going to lose a lot of jobs in the transportation industry. And then there's fall through effect on that, right? What about auto insurance? What about the lawyers that fight accident claims? What about all that stuff? Like, that market gets very different. It doesn't go away, but it evolves. It changes dramatically in a world of self-driving cars. You're going to sue the software. You're going to sue the company. Like, the law changes. The people good at that change. Maybe the people handling it are actually AI now because legal AI is a big thing. So all that changes dramatically. And then I would say maybe the last big change is car ownership. I think car ownership goes down. I think in a world of self-driving cars, self-driving vehicles, and there's a lot of them out there, I think car ownership goes down because I believe, and this is just a hunch based on what I've talked to people. One of the big reasons people have cars is to avoid other people. Like, we kind of have an antisocial society. Like, post-COVID,
Right.
the isolation economy has really picked up. People like driving in their own cars. They like the peace and quiet of driving in their own cars, or playing the music they want, or not having to talk to somebody who's driving them, or not having to be awkward in silence, or feel like they are forced to have a conversation, whatever it may be. They just want their own space. A self-driving car feels like your own space. I've been in a lot of them. It feels like my own space. I play my own music. I set my own temperature. I don't have to worry about anybody, in the front seat or talking or not talking or having awkward moments of silence. It feels like my own space. And so if we can provide that through a service everywhere, then I think the need for a car, a personal car, goes down. I don't think it goes to zero at all. But I think it goes down, maybe 10% to 15%, enough to materially damage the auto market, and enough to give money back to consumers to spend on other things. So that's another part of this that I think changes lifestyle-wise as a result of autonomous vehicles.
Gotcha. Yeah, I mean, I for one can't wait for autonomous vehicles to take over. I don't mind driving. I'm okay with driving. I make drives to New York, long distance drives. It's fine, but it's the day to day. I wish I could just take a nap. driving 30 minutes here, I don't really want to focus on the road. So I'm all for it, if you
Right.
will.
Right.
Gotcha. I do have to also be the devil's advocate for that shift in the labor market. I think truck drivers are probably one of the last trenches of jobs for the average man that you can just kind of go and get after a little bit of training, get your CDL. So with that gone, and then Uber drivers, obviously, like what where do we go from there? How will that affect the labor market? Because that'll be almost a instantaneous shift. I'm not sure where you could train somebody that was a truck driver into a specialized, autonomous truck job.
Well, I think it's not going to be instantaneous. It'll be gradual. I think it'll take time. So that'll help. But you're just going to need reskilling of the labor force.
Hmm.
And actually, one of the investment angles that we're interested in is upskilling of the labor force. Like, what are institutions providing services for upskilling? Are there services out there, trade schools, operators, things like that can upskill the labor force to the AI economy? Um, there are, and that's going to see a huge demand surge. I think. These changes are coming, and you're going to get massive job displacement, and you're going to have to adjust. Like that. That's life, right? This is not the first massive technological disruption we've had. This is not the first time a new tech has come that's going to take a bunch of jobs. Industrial revolution. Hello, anybody. We pull
Right.
people out of mines to do other things. How are you going to retrain somebody that's been? It's tough. It's a transition period, but eventually, it's good. You don't have people working in mines and getting black lungs and dying young. And now you don't have people like transportation or truck drivers, to my understanding, at least the ones that I know, they work it's grueling work. You
Hmm.
drive 12, 14, 15 straight hours, you sleep 3. Like you are it's hard. It's demanding. It's exhausting. And so maybe we pull those people out of that work, and it's a tough transition, but eventually we get them in future generations into a better line of work that is not as exhausting or demanding or grueling or takes you away from home as much. So I think the upside benefits in the long term are massive, but there obviously is going to be a short term disruption. Again, just like the Industrial Revolution, we pull people out of mines. Great thing for those people in the long term and the future generations and whatnot. But yeah, in the short term, very, very tough disruption.
Right. Right. Yeah. Things will change. I guess I am looking forward to more walkable cities. Just less congestion with vehicles. It sounds like something that'll happen when vehicles are autonomous. You hop in, you get out, and the car just goes somewhere else, right?
I think there's a lot of upside benefits to it. Yeah, I think less accidents, less traffic, more optimized just flow of cars. There's a lot of upsides to having an autonomous logistics network.
Definitely. Okay. Yeah. I'm sorry for ending it on a slightly sour note, but I do want to ask. Do want to ask Luke? Do you think there's anything about this week that we might have missed that we didn't cover today that you want to let the viewers know about?
No, I think we talked about the good, the bad, and the ugly. Talked about it all. I think I mean, markets are in a great position, but AI is going to be a massive transformation that's going to cause a lot of disruption and change, and change is uncomfortable, and it can be painful for a lot of people. But in the long term, I think it'll yield positive results. It'll create a society of utopia, and I'm very much looking forward to that. To best position yourself for this disruption, you got to be aware of it, got to understand how to use it, and you got to start using it. Leverage it. If you're still in the employment economy, you're still employed, you got to learn how to use AI to beat out your competitors, because if you don't, they are
Right.
going to. Right? They are going to. You got to be the one that uses AI to displace them. Don't let them use AI to displace you. So, yeah, get on the AI train, invest in AI, and learn to use AI. Do those two things, and you're going to be a-okay. You're going to be more than a-okay. You're going to be fine and dandy amidst this transition.
And then with that, that is another week of being exponential. We'll see you next week.